I wanted to make a short video here to go over my own personal IPO evaluation process that I use when I'm evaluating investments. I'm specifically focused on IPO tech stocks, but I wanted to explain not just the what I do, but more importantly the why or the logic behind it, and I think you'll find that useful and hopefully helpful in your own evaluations for your own investments as it relates to IPO stocks. So to start off with, on the left-hand side here is the IPO part of a trend. What does that mean? There was some research done roughly 2 years ago, 2016, evaluated all of the available IPOs they could look at, and surprisingly the number one determinant was not, for example, financial metrics of the company itself, but rather what was the long-term growth expectations for the industry that that company was in. So that was a little bit surprising, but it actually makes a ton of sense if you think it through. And by way of example, let's think back to Microsoft. Microsoft, of course, was a very strong and is a very strong company. But when they IPO'd in '86, they were riding the long-term growth expectations of what? Desktop computing, the move to desktop computing. So that was something that was a big change. You know, you had previous mainframe and mini computers previously, and this was a new shift into a very strong and growing trend. And pretty much from '86 to 2000, it was a very strong and successful ride. Once that trend sort of petered out, you know, Microsoft itself didn't change. It was still a great company. Well, of course, I left in 2000, so maybe that was a factor. But nah, just kidding. But again, the trends changed, and you had sort of the rise of the smartphone when you got into 2007 or so, which Microsoft wasn't part of, and PCs and desktops were kind of stagnant at that point. So Microsoft was still a great company, and yet the stock really didn't perform at all. By contrast, now that they've moved into with Azure and Office 365, moving into cloud computing and software as a service, which are actually the two strongest trends in my opinion currently, the stock started to perform again. So you really want to have that combination of course, you know, you want to pick a strong company, that's important, but within that, it's even more important that that company's in a great industry with a good long-term growth trend to it. And that as a follow-on, I read another book, and they talked about in their research that, again, you were far better to, this is more about starting companies, but you were far better to be a good company in a great industry than a great company in a good or of course a worse, a bad industry, because it's just fighting against the wind, so to speak. So that also kind of came to the same conclusion as this IPO research, but they sort of reinforce each other. So those you know, that's the number one filter, is it a strong long-term growth expectation for the industry. And what I'm focused on currently, where current is June of 2018, is cloud computing, which has been going on for a while, and I believe will continue probably to 2021, 2022 as a very strong trend. And of course software as a service, which is really using the cloud to leverage that. So the other takeaway from that book that I mentioned that ties into this was that out of all the industries they evaluated, software was the number one best industry. In terms of, if you want to pick a great industry, it's software. And the reason for that is the cost of adding users, or in effect producing new product, is incredibly small. By way of example, you know, if you're Nike and you're making shoes, no matter how good you get at making shoes, there's always going to be fundamental costs involved, whether it's labor, parts, materials, logistics, transport, and so forth. Those just don't go away no matter how efficient you can get at it. So you always have this higher cost process. And where higher costs, meaning by comparison, imagine somebody logging on and signing up for a Facebook account. Infinitesimally small cost to Facebook to add, you know, more users, and can be done at a very rapid pace, and yet all of those users can immediately start contributing to revenue to Facebook by virtue of seeing and clicking on ads. So that's an example, but that is the number one filter to use as IPOs come out, in my opinion. And so, you know, you have a lot, 5 to 10 a week coming out, but it's pretty easy to screen, because initially, if they're not a company that's in a long-term growth industry, I just move right on, because that's not, you really need that combination of long-term growth and of course ideally a strong leader within that trend. So moving on to the next point, wait for the base. This gets into moving away from the fundamentals and into the technicals of the stock itself. The key initial point is avoiding the first day. There's obviously a lot of excitement around an IPO and you want to get in right away, but it can be a very stressful experience to get in on the first day and watch it go down, and the next day going down and continue to go down. And there's a lot of hype to some degree in terms of surrounding that initial opening. So in my opinion, it's definitely much, much better to let the stock sort of settle down and sort of show its trading range, what the initial valuation is, and watch it and then wait for it to break out of a range. Let me get my little pointer going here. And I'll show, so basically we're really not going to try to purchase until we see a breakout, ideally a breakout on high volume indicating strong demand, and ideally that's had a little bit of time to sort of shake out the weak holders, meaning the people that are just really in it for the short term, because you do have to have not just a strong company, a strong trend, but a good stock. And a good stock means that there's demand for the stock. There's not tons of it around that's going to just result in excessive selling pressure. So you do want to have it prove itself by purchasing on a breakout. And of course, once you get the breakout and establish your initial position, it's definitely important, and I've definitely need to improve myself on this, but you need to focus on the long-term picture, i.e. 3 years type of plus. The reason for that is, again, you're trying to find a company that's a strong company that's riding a very strong trend, and that has a breakout. I mean, there's a lot of things coming together that don't happen all the time, and so once you get them, you definitely want to ride them and maximize the profitability from it. And so once it gets going, I like to watch, for example, the moving average if it dips below and then starts to break out again, and try to add to it there, and also earnings results. Earnings results, of course, give you a much better indication of what's happening behind the scenes to the company, and of course to the long-term trend that they're riding. But a lot of times research has shown that people underestimate the import of the results, and so you'll a lot of times have a pop, and then it kind of hangs around for a little, doesn't do anything, and then takes off. And again, that's, you want to stay focused on the longer term picture and use those earnings results as opportunities to continue to add when people are underestimating the value of those results. So my last point on this slide, avoid my Netflix mistake. And my Netflix mistake, I was not actually involved in the initial IPO with Netflix, but kind of the summary was that it went out and it took off and did great, and then it had a huge crash. So I think it was 2012. I've been watching it as an opportunity to get back in, since I didn't get in on that first ride, and had pretty good timing for a move up, somewhat of a breakout, and I think in 2 weeks had a very, for me anyway, a pretty healthy profit. So I sold because it looked like it was peaking, and I think I was right actually. For the next week or two it did actually go back down, so that's all well and good, but ultimately, you know, they then had some nice earnings. It popped, more breakouts. I didn't really follow the stock, and it took off, and of course here we are 2018, and you know, effectively kind of made pennies and lost dollars, because it was a very substantial ride for the stock. And again, that long-term trend that we're riding at that time was the move to digital streaming, which is why I'd gotten involved in it and away from the physical DVD business. So that's an example of a mistake. But again, you do want to ride and add and leverage. You know, opportunities like this don't necessarily come along that often to combine long-term trend, strong company, a breakout indicating strong demand for the stock. I mean, those are really putting all the odds in your favor. So you definitely want to maximize your results from that. So let me move on to Facebook, which I think will kind of tie a lot of this together in terms of an actual stock. So this is Facebook stock from its IPO in I believe it's 2012, running out till the current on the far right there is June of 2018. Now this is weekly, not daily, because I wanted to show the overview of what happened here. So here's your IPO on the far left. Red, if you're not familiar with stock charts, there's a candlesticks. Red means that it opened higher and closed lower, meaning it went down. Green, of course, is the positive, meaning it went up. But going back to getting burned on the first day, what we see happen here is there's a lot of excitement around it. At the time, the long-term trend here that Facebook was riding, of course, was the rise of social media. Had very good long-term growth expectations, so it met the criterion. But what happened? It opened and immediately went down. The next week down again. A little bit of a pop, and then for the next couple weeks down, 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 down. So I think there was some lawsuits and lots of people stressed out. But ultimately, if you bought on the first day, more than likely you probably exited at some point here at a loss because you watched your money, get clipped in half in a month or two, and that's not, even if you didn't sell, it's not a fun experience. And by contrast, if we move out almost exactly a year later, this purple line is effectively, it's a little bit high, but I was trying to show sort of where I would be targeting for a breakout. And what we do see happen here is nothing, 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 and then suddenly it starts moving. We've got, this is a volume chart, we've got substantial volume indicating a lot of buying pressure, and we've got the stock moving up. And anywhere in here we effectively have a breakout. So that's the breakout of the trading range we'll be targeting, and this is the time to buy. And what happened here? We avoided the stress of all this. We didn't have our money or capital tied up for a year in a non-performing investment, and we're able to, get in at the right time. So from there on out, get the pointer, but from there on out, very steady, smooth, happy ride. And of course, you had little breakouts if you targeted this high and then a re-break here, target this high, re-break here, and so forth. Continue to add to your position, particularly as earnings roll in and things continue to evolve. So, but that's, again, this is almost a 3-year chart, maybe a little bit more, but it does sort of show you the performance results of continuing to add to your winners. So that's a classic example, and that is, again, why I do things the way I do it, and the research and logic behind it. So I hope this information is helpful to you, and wish you the best of success in your own IPO investing.